Okay. So, please, I hope you have your writing pads by you. I hope everything is set. So you write this. So we are going to break the syllabus into 5 questions, right? Question 1, question 2, question 3, question 4, and question 5. So now we'll introduce some new alternatives, right? So first of all, I want the first areas to be about tax planning, tax planning, avoidance, and anti-avoidance. So write it down. Are you writing? So this is the first area. Now, question 2. I want us to talk about the tax incentives in the Ghanaian tax law. Okay. So tax incentives. Okay, so tax incentives, we are going to look at, even in the tax planning, we are going to look at the aspects of some aspects of international tax planning too, right? So this that your examiner is going to add a little sprinkle of international tax, which people are not expecting, I know. People are not expecting to see international tax in strategic tax planning, but I know, don't worry, you'll be fine, right? It's just issues on teachers, DTAs, artists and sports persons, and then, those kind of things. The basic provisions that, in the DTA, foreign tax credit. But this time, the foreign tax credit, if it should come, it won't be like you have to calculate, right? You have to explain what kind of relief, okay, what kind of relief is that person going to get, or that person going to enjoy. Do you get what I'm trying to say? So we are saying that yes, if it comes to that area, what kind of relief are you going to enjoy? So are you going to enjoy a deduction, an exemption, or what, a credit, right? That one you explain based on the scenario. Now they want to make your tax, your international tax and strategic tax planning, they want to merge it, so that you do more of international tax planning decisions and stuff like that. But we'll look at every area, from those areas to that area, everything there is to know. Now, let's say after tax incentives, we are definitely talking about the tax concessions, right? The tax reductions, or simply tax relief. So reliefs are made up of reductions, credits, and rebates. So we have the exemptions under the law. We have the deductions under the law as well, right? So all these are examples of tax incentives that we have under the law. Then question 3, let's reserve question 3 for financing, okay, financing and investment options. Before, it was just financing, but now we'll add the investment options to it. And when we talk about investment options, we are talking about tax-favored investments, okay? So when you hear something called tax-favored investment, what does it mean to have a tax-favored investment? What does it mean to have a tax-favored investment? Do you understand? I'm asking you a question, everyone is silent. When we say a tax-favored investment, what does it mean? Yes, I'm asking a question. Tax-favored investment. Mm-hmm. Yes, I don't like the silence. So when we say something is a tax-favored investment, what does it mean? Tax-favored investment. What does it mean?
Okay, so
Yes.
um, you taught us that when it comes to financing, it could be debt financing or equity. So probably tax service incentives will be whether to go for debt or equity. The one that will give you the optimal result.
Okay, that one is financing. But here I said tax favored investment, an investment that gives you the optimal tax position, right? So apart from just looking at financing, a typical example of tax favored investment is the acquisition of assets. You know that because we get capital allowance for it, right? Leasing. You know, there are some tax favored. It's also a tax favored. You know, lease or buy decision is also an investment decision as well as a financing decision, right? Knowing when to particularly invest in something. So let's say hedging. Do you know hedging? The purchase of swaps, derivatives is also an investment, right? But this purchase of swaps and derivatives can also be a good tax favored investment, right? Is that okay? Please, are you learning?
Yes.
Understood. So we are saying that now when you're looking at financing options, don't just focus on the debt and equity, okay? Look at other aspects that the taxpayer can also channel his income, okay, to give him money. Because it is either I'm investing debt or equity into a company. Okay, what if I don't invest into a company? Then I can invest those same monies into something else. Does that make sense to you?
Sure.
Does that make sense to you? So it's not always that a company or an investor would always be concerned about, you see where the financing now they are taking it. It's not always that you'll be expecting to invest debt or equity in a particular company, but you may literally also invest, okay, you may literally also invest in a different arena. Maybe, okay, I want to go and buy swaps. I want to invest in a foreign currency instrument, right? I want to invest in a business, right? I want to invest in maybe stocks, shares. Okay, I want to invest in trading inventory. I want to buy cars. It could be anything. But the thing is that no matter where the person decides to channel his finance, okay, that investment strategy should lead to a tax-favored investment. And this is one aspect of tax planning I don't see a lot of people look at, because tax planning for a lot of Ghanaians is short term. Tax planning should never be short term. Is that okay? Tax planning should never be what?
Short term.
Short term. Why? Because there are some investment plans that span across years. And the whole thing is to minimize the cost that comes with it in present terms, as well as what? Maximize the value that comes with it, right? And thereby reducing the tax cost. Because, you know, so far as we say 1 cedi is valuable than 2 cedi, 1 cedi is more valuable today than what? 1 cedi in the future. It means that cost in the future, are you getting it? Are less what? Are less valuable than cost today. Do you get it? So if we can push our cost into the future, then they will be less expensive because of the time value of money. Does that make sense to you? So as a tax practitioner, you must be able to utilize the power of the time value of money, because when you shift cost into the future, they are less expensive. That is what it implies. That is why we have tax shifting strategies or income shifting strategies, right? And that is very important. That is why base erosion and profit shifting, people also consider this or do realization, right? So something like replacement asset can help you shift the realization into the future, right? So that you pay when that asset is what disposed of. This is an example of income shifting strategy. Is that okay? So now I want you to have a broader perspective when it comes to tax planning, but not just the things that we have been talking about, right? So now your focus should be more around what? Tax favored investments. Please, is that clear?
Yes, sir.
So now we've seen this financing and investment options. Question 4, I want question 4 to be focused on what? Establishing a physical presence, right? So establishing presence. So establishing presence means that you are looking at various entity choices. So entity choices and their tax implications, right? Or their tax consequences. So looking at the kind of entity you can set up. Okay, you can have an entity which has a multi-entity. When we say a multi-entity, in simple terms, let's look at multinational entities, right? Which have a lot of branches, a lot of group companies under them. So here is where we'll be talking about what? We'll be talking about group companies, okay? So in the space of talking about group companies, you get it? When we are talking about group companies, what are, anti-avoidance provisions in Ghana are mostly centered around group companies, right? And one thing you should know is that when it comes to group companies, there's so many things that they always try because tax avoidance is legal. Group companies will always find a way to pass tax laws. That is the focus of your exam from this date going onwards. Okay, it's not like before. There's going to be slight changes, which will require you to think small. So if you think tax planning, oh, the questions are always the same, I'm telling you, this date is going to be a little different. Something small, a little sprinkle of international tax planning. So that is why I'm talking from that perspective. Multinational. Multinationals always have the goal of paying as little tax as possible. Okay, so your duty is to know how to either help them or help the authority. So in exam, look at the role you are playing. Are you working as an officer of the authority to implement anti-avoidance provisions, or you are working as what? An international tax expert to bypass the anti-avoidance provisions by looking for more loopholes? Okay, so it depends on the role you are playing in a specific scenario. Does that make sense? So have this in mind. Let's come to question 5. Question 5 is where we talk about what? Realization. Okay, so realization, we are definitely talking about the sale of assets. Okay, so first of all, mostly your exam is about sale of assets or settlement of liabilities. This is a rare case, settlement of liabilities. So when you settle a liability lower than it is worth, it means that you have a gain, right? Then we talk about what? Sale of business, right? So it's either you are selling assets in a business or you are selling what? The assets, or you are selling the business itself, right? So this is change in ownership, right? This is the common thing that you should get, or you have sale of assets or settlement of liabilities. And note, if you look at the structure of tax planning, these are the 5 major areas that span across in a Ghanaian tax law, okay? So I want you to put them down. We are now going to take them one after the other to know some of the things that we should know under them, right? For a successful or for a breakthrough in strategic tax planning. These are we okay? So I want you to put this one down. So,
Bill,
yes, please.
in fact, it appears you are moving too fast. I mean, this intervention, if you could slow down a bit and talk, then we can pick up.
No problem.
But it appears you.
But this one, just write it down. I'll take it step by step, okay? I would.
I mean, the question 2, the tax incentives. The first, this one you wrote is what? Tax what?
Concession.
Okay, thank you.
And it follows with tax reductions or tax reliefs. Then it comes to tax exemption. Then it comes
to... it seems more like tax, the areas of tax planning.
Yes, those
are the same
areas of tax planning, yes. Those are the same as the areas of tax planning. So put them down and let's look at what goes into each area. So we'll look at what goes into each area in brief. Okay, just a brief. Every area we'll look at it in brief. Every area we'll look at it in brief. Then we'll now dive deeper into each of those areas. Okay, so if you are done, you tell me, then we move. Put it down. These are the 5 major areas of tax planning that we must understand.
Yeah, but tax incentives, you were talking of the margins, the variables of the tax planning. That's the lead.
Yeah, so it's not only
Madam Chief.
it's not only about that one. We go beyond the maxims, right? So we even look at international tax aspects, international tax planning, like using withholding taxes, using what do we call it? DTAs, using mutual agreement procedures, okay, and those other things. I hope that is okay.
Yes, yes.
Okay, then. Please put it down, and then I think we can go step by step by step. Okay. Have you put it down? Can we go? Or you're still writing? So these are the areas of tax planning that you need to know and master. Hello, is everybody okay?
Yes, sir, we're okay.
Yeah. So can I move?
Yes, sir.
Sure. So now let's take the first area. The first area is what? Tax planning, avoidance, and anti-avoidance, right? So what do you need to know under this area? Now, this area starts by knowing what is tax planning. Okay, so I'm giving you all the necessary questions. So what is tax planning? So when we talk about tax planning is how you arrange your financial activities, right? You structure your activities, your financial transactions in a way that will lead you to what? Get all, okay, get all the what? The benefits, okay, under the law. Okay, and benefits under the law, we know it includes things like what? Concessions, reliefs, exemptions, and what? And deductions, right? So we are saying that planning your activities in such a way or arranging your financial in such a way that you end up getting all the necessary concessions, all the necessary reliefs, all the necessary exemptions, and all the necessary deductions under the law. Okay, so these are the various what? Areas where you get your tax benefits from. That is the first plan of tax planning, to get all the benefits, thereby reducing your tax liability, right? So why are you doing this? To reduce what? Your tax liability. And three, to pay not more than you are required to pay, right? To pay not more than you are required to what? You are required to pay. So we also do tax planning not only to minimize our tax liability, but also to make sure that we do not pay more than we are required to pay under the tax law. And another aspect of tax planning, which people don't often talk about, is to ensure we do not incur penalties and sanctions through our planning, right? And this is an aspect of tax planning which people usually ignore. We call this tax management, or that's tax compliance, right? So we are saying that, okay, now you have decided that you are planning tax for a client. Okay, good. You are planning tax for a client. Now, as you are planning tax for that client, you realize that the client, you end up, okay, let's say there's an investment which you have to do, right? With 100,000 Ghana cedis. And this investment, you have to invest this now, and you are going to get the present value of cash flows, right? Of how much? Let's say 200,000. Is it a good investment? This session should be interactive. Is it a good investment? So you are going to invest 100,000 now, but you are going to receive 200,000 in return today. Is it a good investment?
Yes, sir.
Yes. So all these cash flows, assuming they were maybe in 1 year's time before you start getting this, a tax manager should be able to say that, okay, this investment that I'm going to do, if I invest this 100,000 now, let's say I have tax liability, right? I have tax liability of 100,000. But can I forego this tax liability of 100,000, get 200,000 in 1 year's time, and use that 200,000 to pay my penalties and interest plus the tax, right? That would arise on this income. If I can, then it's a good decision. But wait, if you take this plan, you are not also doing proper tax management. Proper tax management also comes with what we call reputation management. Do you know that there's a cost that comes with reputation loss? Does that make sense, everyone?
Yes.
So we are saying that, okay, if this investment, I have tax to pay of 100, and I know that this 100, I can put it somewhere, I can invest it somewhere, and then generate 200,000 cedis above that 100,000. Then what if I just delay this tax and then I get that 200,000 in 1 year's time and I use it to come and pay all the liability? It's not a bad decision, but then your reputation will be at stake, right? You become non-compliant. You all agree? So what is the best decision to take? This one is optional. Everybody will have a different way. Yes, what do you do in this case? Yes, what do we do in this case? Based on what is at hand, what do we do? Should we take up the investment or we should pay the tax? And the investment too is necessary to maximize our shareholders' wealth. So as a decision maker, as a senior financial executive, what are you expected to do in this scenario? Yes.
The entire thing, I go for reputation.
Yes. So what would you decide to do? This one is optional. Obia on the own variated opinion. So yes, what are we saying?
Sir,
Yes, please.
can you arrange to pay the tax in installment basis and then do the investment?
Yes, it is possible. Everything you decide is a matter of writing an appropriate documentation and speaking with people. Remember, no matter what we do, we are still speaking with people. We are still dealing with people, right? So the whole thing is to know what to do. So I think it's a just you want to say something.
Yeah, but I will go for the reputation. I would rather pay now to avoid my name being published in the dailies showing that I owe, and that will harm my business.
Now, what about the 200,000 investment? And the 100,000 investment, what happens to it then? Would you let it go?
That cannot buy back the loss in my reputation.
That cannot buy back the loss in your reputation. Okay, that is good. I like the answer. Yes, any other? Who also wants to go risk seeker? Just take up the investment. I don't care. My shareholders are the people I need to settle or I need to satisfy. So I'll just take up the investment, wait for 1 year, get the 200,000, settle GRA penalties and interest, and still have something to satisfy my shareholders, who also take that aggressive approach. Or everybody prefers the reputation. Mhm.
Going by the risks also comes with possible penalties and sanctions. Is that not it?
That is true.
So at the end of the day, the sanction and the penalties may write off the returns that you would have gotten for taking a reputational risk.
Yeah.
So you better you are better off being on the side of the law compliance than possibly taking that risk. Well, I would rather would have gone for the risk anyway.
Okay, so you go risk averse, eh? Razak, you would have
Yes, I'll go risk averse. Yes.
paid the tax.
No, I'll take the risk and invest and pay up
But
later.
and pay later. But then what about your reputation?
That's what I'm saying. At the end of the day, the reputation is also supposed to inure to your benefit.
Okay.
So if the benefit of the investment would outweigh whatever the goodwill brings to, I mean, it's worth taking. At the end of the day, like you said, your investors are your primary interest.
But we also owe the society, right? We also owe the society to act in their best interest.
Yeah, but it doesn't mean that you are not going to pay. You only delay in payment.
So this
So
is
you would have satisfied the
so we could say this is a tax deferment strategy, or
strategy. Yeah.
yeah. But the thing is, you see, tax planning is a skill. Okay, I'm coming. So that I draw the scale. I want to open some other areas of tax planning we are not talking about, but the thing is slowing down. Why? Open the steady text. So let's look at something. I hope you have your steady. You're looking at the pitfalls in tax planning. So let's somebody reading for us. No guest talk. Mano, can you help us? Mr. Edu, he's my personal person.
Hello, Boss Bill.
Can you take us through pitfalls in tax planning?
The hot.
Pitfalls in tax planning.
Oh, okay.
Read for us.
Because I'm still in the office, I have some divided attention.
Okay. That's fine.
Okay.
Then we need one lady to read for us so that we can. Or you, let's go. Okay, pitfalls in tax planning. There are several pitfalls in tax planning, which include the use of illegitimate transactions through tax avoidance and evasion. Okay. Now, when we say something is a pitfall, what does that mean? When you say something is a pitfall, another word for pitfall.
Oh, hindrance.
Shortfall.
The fall is still there. That fall, no, what does it mean? That's what I want to know.
Gap.
Sir, can we also say loophole?
Loophole.
I think
It's more
roadblocks.
limitations, right? Pitfalls are like limitations. Or what do you say? Do you all agree?
Yeah.
Yeah, a pitfall is like a limitation or a loophole, as you said, right? These are limitations or shortfalls or disadvantages of some sort. So we are saying that there are several disadvantages in tax planning, pitfalls, shortfalls, loopholes. They are all talking about the same thing. And this may include where people use illegitimate transactions. I get it through tax avoidance and tax evasion. But what I want to ask you is, what is the difference between the illegitimacy of a transaction and the illegality of that transaction? You know, a transaction may be illegitimate, but not illegal. Do you understand? So what's the difference between illegitimacy and illegality. Everywhere is quiet.
It sounds more like tax avoidance and tax evasion. Where evasion is illegal, but the avoidance is the other one.
Okay, so my question is, what is the difference between something being illegitimate and something being illegal? You know, in real life, there's a slight difference, right? Or there's a thin line between tax evasion and tax avoidance. Excessive avoidance still constitutes evasion. Do you agree with me? Because if you know that thing is reducing your tax liability and you keep doing it excessively, then the authority can take you up. Because definitely you start breaching the laws of economic reality, which is things like substance over form, you know, those other stuff. You start breaching them. And what happens is that it starts looking more of an illegal position you have taken. Does that make sense? It starts looking more like an illegal position you have taken rather than what a legal position. I hope that is okay. So, what are some of the pitfalls of tax planning? The first area is tax costs. Now, firms that engage in tax planning may face some adverse implications in achieving the objectives of tax planning. One, not all tax planning activities necessarily decrease tax liability to one's desired minimum level. This is because tax planning is also associated with costs, like costs directly related to tax planning. For instance, when I engage a practitioner or I engage a tax planning expert to plan for me, won't I pay the person? So some people don't pay attention, right? But let's say you go and hire a tax expert, right? Look, you are paying this tax expert $3,000, right? Okay. Now, this guy ended up saving you in taxes, right? Saving in taxes. He ended up saving you $1,500. People usually forget. Hey, this guy saved me taxes, oh, but they forget that they are paying this person $3,000. So what has happened? Did you lose or you gained? Did you lose or you gained?
You lost.
You lost. You lost 1,500 without noticing. And this is the problem. The last time I encountered one client and I told him and he said, hey, it didn't even occur to me. Oh. So apparently he sent his waste management problem, right, to a tax practitioner. And the tax practitioner charged him 3,000 cedis, right? Now, upon negotiation and let's say $3,000, upon negotiation and talking with GRA, doing tax and all that, taking incentives and stuff, there was a tax saving which the guy made for him. And that tax saving, I think his total liability, let's just assume that his total liability was 20,000 Ghana cedis, or let's say 120,000 Ghana cedis. And these people negotiated with GRA, brought in some tax incentives and stuff. And then his liability came down to 100,000, right? Okay. This guy was so happy that he has saved 20,000. Is it not good? Has a tax expert not done well? Has he not done well? He has done well, right? He brought your liability down to 100,000. Okay. But you are paying him $3,000. And let's just say that the exchange rate is now 10 cedis. How much would you have paid this guy? Is it not 30,000? Is it not?
Yeah.
But to you, you see, because we don't consider like, oh, this one, I went to give it to KPMG. We don't consider that side. Oh, KPMG, they are good with, oh, let them do the tax. And they go and bring your tax down by 20,000. You are happy. Oh, these guys, they've done well. Charlie, my tax was 120, or much is 100. But have you asked yourself how much you are paying them? You see, sometimes you don't look at these things, but assuming you
Yeah.
pay the whole tax, you would have only paid 120, true or false? But now,
True.
how much have you ended up paying? You have paid 130,000 instead without even noticing. The best tax planning is paying the tax. If only this guy, the savings is going to give you is more than how much. See, if you are dealing with a tax expert, let me tell you, that's one thing you add. He said, Masa, if only the savings you are going to give me are more than how much I'm paying you, then I'm willing to take the deal. If not, then I can't take the deal. A lot of clients don't know this. So, you see where sometimes you are lacking. You wouldn't know. By the end of the day, what happens? Boom, a huge cost. It's on you, but you don't know where that loss came from. Sometimes it's your tax planning. So it doesn't mean that tax planning is always good. No, no, no. It also has its limitations. Does that make sense?
Yes.
Okay. Now, what if the guy saves you something more than? Do you know sometimes there are savings that are not direct, like you can't really tell because they happen from different perspectives. So let's say savings came from concessions, some came from the way you structure your activities, some came from your internal and other stuff. How would you know whether the savings that this guy is giving you is more than the savings that you are getting or the tax that you are paying? How would you know? Yes, this is a question I'm asking. How would you know? You just need to compute. That is the answer. You compute everything. Makes sense. Does that make sense? Okay. Now, the next question is, apart from the cost directly related to the tax planning, like the consultant's cost, the setting up cost, setting up meetings, all these things come with a cost, right? Now, what about, there's another cost which is not really direct, but there's the risk and detection by the tax authorities of what you have to do. And this one, we may relate it to tax audit, right? Do you know that sometimes when GRA sees that you are doing tax planning or tax avoidance, it triggers an audit. And once it triggers an audit, there will definitely be an assessment. Do you know that? Have you talked about this? Do you know that immediately there's an audit, there will definitely be an assessment? True or false?
True.
And immediately there's an assessment and you go and raise an objection. Whether rain or shine, you must pay 30% before they hear your plea. True or false?
True.
So,
True.
no matter the tax planning you do, this one, it seems I'm going too practical, but I hope it's helping. No matter the tax planning that you do, if you do and you do and you do, and your name gets held by GRA, definitely you still pay off that 30%. If you don't agree, it has to go to court. All these tax appeals board to and fro. Your transport, who is going to pay? Is it GRA? Your time, which you should have used to be dealing with your customers, that you have wasted, who is going to compensate? Is it GRA? Have you thought about it? Do you get it? So there are hidden costs, whether you like it or not, when you start planning taxes, okay? The third one is agency costs. How do we explain this? Agency costs. How do we explain this? Agency costs. How do we explain this? When we say agency costs, how do we explain it? Hmm?
Yeah, the cost paid to, for instance, KPMG and others could also be regarded as an agency cost because they would act as your agent and take up your tax planning activities or negotiate your tax liability if there is a dispute and others, and then you pay them for their services.
That is one. Other agency costs include internal agency costs, right? Like our management doing the right thing. Is management doing the right thing, right? So audit fees, do you know if you don't send audited financial statement to GRA, they won't accept. Remember, so if you are doing tax planning, you still need audited financial statements. True or false? And audit is an agency cost to check whether directors are doing the right thing. Do you know that? Apart from that, setting up internal controls to ensure these people are doing the right thing so that they will not collude or bypass these controls are all examples of agency costs. Giving managers bonuses and all that to check whether they are complying with the rules. Because this one, agency cost starts from within. Then the external agency costs are like paying KPMG, paying auditors and other stuff. Razak, I hope that is okay. You get it. So we are saying that these things also play a part in tax planning, because if we are going to comply, it begins from management. True or false? It does, right? Now, the whole thing is that sometimes these costs outweigh the benefits derived from tax planning activities. And there are other non-tax costs, okay? Things that are qualitative in nature, but they are associated with tax planning activities. Some tax costs, some non-tax costs may include the loss of efficiency in your internal controls, potential penalties that may be raised, potential price discount, right? For instance, some people take up some particular decisions because they want to get tax planning. The tax authorities may consider these decisions that you have taken, I get it, as non-business decision. Like it wasn't done because of business, but just to take advantage of the tax law. And then it may be a damage to your organization's legitimacy. People may see, or the authorities may see your organization as not legitimate. Because for instance, look, a company that has seen that if a resident company A acquires a resident company B, right? If dividends, let's say acquires 25% or more of this company, right? If dividends are paid by B, then what happens? The dividend will be exempt from tax, right? Okay. Now, a US company has seen this. It's not a resident company. It comes to buy 100% of this company. And then investors or people will see that, assuming the tax authorities see this, they will not trust your organization. They will think that this organization is purposely set up as a special purpose vehicle to just transfer this dividend to the US company. Okay. And what that means is that when this happens, they do not see your organization as legitimate, because they see everything you do as just transferring indirect payments from one position to the other, right? Resulting in what? Illegitimate organization. So people may think, oh, this organization is not legit. It has been just set up to be transparent stuff, right? And also you lose reputation because you are not doing things for business purpose. Does that make sense? Okay, so let's continue. So there are some penalties that will also be imposed by the tax authorities, right? There are some reputational risk. We talked about it. So overall, some of the pitfalls are the costs directly related to tax planning, the costs that are not directly related, the risk of detection by the tax authorities, the loss of efficiency in internal controls, potential penalties, potential price discounts, damage to organizational efficiency, and reputational risk. Okay? So are we okay with the pitfalls in tax planning? Any question? Any question? So we are still under the first part. What is tax planning? We have talked about that one. We have looked at the disadvantages or the areas or the weaknesses of tax planning. Now, the next thing I want us to talk about are the areas of tax planning, right? What specific areas do we need to cover in tax planning? Now, when it comes to tax planning, actually, tax planning is so broad. It can talk about open and closed transactions, permissible and non-permissible tax planning. I can talk about long hold, short-term tax planning, long-term tax. There are so many areas. But the areas that I want to focus on are the areas in the tax law, right? Where tax planning is concerned about. So the areas in the tax law that the tax planning is concerned about is mostly what? These areas. The first one is what? Your tax concessions. And these tax concessions are basically what you guys know as tax holidays. Oh, exactly. Okay, so we have tax what concessions. I hope you are writing it down. The tax concessions, which you know has tax what? Holidays. Make sense? Then we have tax reliefs. The tax reliefs also, there are different types of tax reliefs. We have what we call a tax, okay, let me use, instead of tax relief, let me use the right word. Tax reductions, right? I like that one better. Tax reduction, things that reduce your tax liability. So for tax reductions, we have what we call a tax relief. We have what we call a tax credit. Okay. We have what we call a tax rebate. So anytime you hear these are all examples of tax reductions. They reduce your tax. A rebate is a discount in your tax rate. It also reduces your tax. So we have tax concessions, tax reductions, we have tax deductions. So the tax deductions are the deductions that are allowable by the tax law for you to deduct. This is what we call allowable what? Deductions. Okay. This is what we call the allowable what? The allowable deductions. Then we have tax exemptions, right? So one area of tax planning is tax what? Exemptions. And tax exemptions are various exemptions under our law that you can enjoy, right? And the particular exemption that I'll mostly talk about is Section 7. We also have exemptions under specific areas, Section 59 for shareholders. We have exemptions for PE. We have exemptions for, international tax, some exemptions and other things. We have exemptions. There are so many exemptions spread across our act. There's even exemptions for companies, right? 47. There are some exemptions, plenty, but exemptions are plenty under our law, right? Okay. Now, another area which you don't necessarily see is one area of tax planning, which I call tax management, right? So what did I tell you earlier about tax management? What is tax management? In your own words, from whatever we have discussed, what is tax management? What is tax management from our own explanation of what we just discussed earlier?
Arranging your financial activities in such a way that you don't pay more than you are supposed to pay.
More than you're supposed to pay, and then you do not attract penalties and interest, right? So tax management is all about compliance. Does that make sense? So tax management is ensuring compliance. So when we talk about the areas of tax planning, these are the areas of tax planning that we usually will talk about, right? So those are the areas of tax planning. Have you put it down? I want you to put it down. These areas alone, if I decide to go through these areas, it means you have finished the whole.
Yes.
If I go through these areas, it means you have finished tax planning. But then I'll take it from a different perspective. I'll take it when we get to incentives, right? So put it down, and then let's come and look at strategies used, common strategies used in tax planning. So common strategies used in tax planning, okay? So the common strategies used in tax planning, there are three main strategies, right? There are three main strategies used in tax planning. So write it down. There are three main strategies we use in tax planning. The first is what we call a what's the word I want to use?
Timing.
Is that?
You want to use timing strategy.
Timing strategy.
Time variable.
Yes, we can call it the time value strategy, time or deferment strategy, right? But I like timing. I usually use timing, but there was one particular word I wanted to use. So let's use timing. This is where you time the right way, the right time to buy an asset. This is where you time, okay? So can I do this? Can I take this deduction at this date, right? So example of the timing example was when we had that investment of 100,000 and when that we have to pay penalty, right? So you look at the right time to take advantage of this, and this requires careful planning, right? Does that make sense? This requires careful planning. So if you know that, oh, VAT is going to reduce next year, some transactions that you want to do this year, you can shift them to next year. Does that make sense? So that you enjoy it. So that is careful planning using the timing strategy. The second area is income shifting strategy. So this is where you shift income from either one jurisdiction to the other or from one form to the other, right? So mostly this one is jurisdictional shifting. Sometimes we call this base erosion and profit shifting. You erode your base and shift it. So through the use of what? Transfer pricing, through the use of income splitting, through the use of thing capitalization, you can shift income from one place to the other. The third type of tax planning strategy It's what we call tax conversion or income conversion strategy, right? So you can convert one form of tax to the other or convert one income to the other. I hope that makes sense. So this is where we see the issue of closed companies, right? Or closed companies have gone far. When a sole proprietor, okay, when a sole proprietor decides that he wants to pay himself salary, okay, or a sole proprietor takes drawings, okay, or he decides to pay himself salary. Remember that this salary should have been part of the profit of the company, true or false, of the sole proprietor, true or false? Because at the end of the day, doesn't all the money come to the sole proprietor? Doesn't all the money come to the sole proprietor?
Yeah,
It does.
But he has intentionally converted some of the profit into salary so that this salary will be treated as allowable deduction for him. Do you get it? So he has changed, he has converted one form of income to the other just to enjoy a benefit. Or a portion of the profit, he has converted it to drawings so that it can be deducted. But if the Commissioner General sees this, he realizes that this thing is part of your profit, so he will disallow it, right? And this is some sort of anti-avoidance provision to stop you from taking advantage of this conversion strategy. Are you getting it? So anytime there are some strategies that you are going to use to take, so these are like how to take advantage of these things. So these are like the what we need, and these are like the how to get the what. Do you understand? Does that make sense? Strategy are tips, tactics, techniques. Are you getting it? To get you to achieve your objective. The objective is that we want to use this to achieve the objective, which is what? Either what? Reduce tax liability or pay no more, right? Pay no more than expected. Okay. So this is the objective that we want to achieve. So what do we need to achieve this objective? We need concessions, reductions, deductions. But how do we take advantage of this? Through these strategies. Make sense to everyone? Does it make sense? Does it make sense?
Yes.
We have seen the areas of tax planning. We have seen the common strategies that are used in tax planning. We have seen the main of tax planning. Are we okay? This is tax planning. Now that we know what tax planning is, the next question is what are the objectives of tax planning? Okay, the next question is what are the objectives of tax planning? So tax planning has so many objectives, but the main objective of tax planning stands to be the minimization of what? Of your tax liability, right? This is the main objective of tax planning, to minimize tax liability. Okay. Now, apart from this, what other objectives of tax planning exist? Two, to minimize litigation, okay? We want to ensure that we don't get sued. And how do you minimize litigation? So here the focus is mostly about what? Tax planning, but here the focus is more about what? Tax management, true or false? You know, tax management is also an area of tax planning. Do you guys remember? So to minimize litigation, we know tax planning is legal. You are working within what? The framework of the law to take advantage of all the necessary benefits. But the thing is that if you work within the law, is somebody going to sue you?
No.
No. Another objective of tax planning is to lead to economic growth, right? Channel income to productive investment in the economy. Okay, productive investment in the economy. Create what? create employment for people, right? Create employment for people. And then you can also talk about what? To increase disposable income in the hands of people. Usually, I think tax authorities bring what? Tax incentives, for instance, to help people get more money in their hands. Because, for instance, if I give you relief, that relief should reduce the amount of what tax, and thereby you having more income. So it's like income minus tax is what? Oh, why is this thing messing up? So it's like what? Income minus tax should give you your disposable income. True or false? True or false? So if I make 1,000 cedis and they take tax of what? 200 cedis, that means my disposable income is 800 cedis. What if now I did tax planning and I took some relief, okay? That reduced my tax now to 100 cedis. So it means that how much is my disposable income now? Is it not 900? Because of tax planning, I have saved 100 cedis. True or false? True or false?
True.
So tax planning can also help you to increase disposable income, okay, in terms of what you are doing. But one thing I want to talk about is, let's look at some points. We've talked about this, we've talked about this. Let's look at economic growth. How can tax planning lead to economic growth? How can tax planning channel income to productive investment? How does it create employment to people, for people? Yes? Yes, you answer me. I told you it's an open forum. Everybody has to talk. So how do we see this? Or how do we do this?
Yes, sir. Hello.
Yes, boss, I can hear you.
Yeah, once you plan your tax, you will get your disposable income will be there. Once you have more income, you channel that one to more productive ventures that will lead to economic growth. Now you will get people employed and goods will be available for people to consume. So it will enhance economic growth. Thank you.
Okay. Sure. I like that. But then you remember that because the tax authorities want to ensure, they remember the tax authorities are part of government, right? Government will create something like treasury bills, right, for people to buy so that you can get enough money to what? To build the economy. Do you understand? So it's one way that they can do some of these things to channel people's money into these productive investments, right? So channeling your money into productive investment, it means that there's no illegality. There's no black market money. All the money that is coming is real from people's actual pockets, not from criminal proceeds and other areas, because we work within the confines of the law. Do you understand? So this one will end up what? Growing the economy. Makes sense. Okay. How does it create employment for people? We know that people, you guys are learning to become practitioners, right? You guys are learning to become tax planners, right? That tells you that what? What does that tell you? What does that tell you?
To develop create employment for people.
Creating employment, right? Creating employment for you. Yes, that is why you are learning to become tax practitioners. Okay, so we have seen tax planning. So I forgot. Let's summarize the shortfalls of tax planning. Who remembers them? Let's summarize them. What are the shortfalls? So these are like the objectives or the advantages, right? But we also saw the shortfalls of tax planning. Who remembers them? Let's summarize them. What are the shortfalls?
Agency costs.
So I'm coming. Let me clean. Okay, so shortfalls of tax planning. So one, I think we started with okay,
Costs directly related to tax planning.
agency costs, tax planning costs, right? Direct tax planning costs directly associated with tax planning. Yes. Risk and detection by the tax authorities, right?
Yes.
Okay, what else did we talk about?
Reputational risk.
Reputational damage, right? Or reputational cost. Okay.
Payment of penalty,
Payment
penalty,
of penalties, not so.
non-compliance,
Okay. Then we also talked about, okay, you can bring non-compliance. Non-compliance is one of the shortfalls. Then inefficiency may lead to inefficiency in internal controls. Do you remember? What else can we talk about? Were these all of them? I think so, right? Well, there's another one you want to talk about. There are a lot of shortfalls that were not in my material. But is everybody okay? Can we move?